Good afternoon, students. Today we want to look at capital budgeting, and there are actually four methods. We want to look at the two easier two, accounting rate of return, payback method. So we need to refer to your PowerPoint slides. If you'll go to Blackboard and pull up your PowerPoint slides for capital budgeting. I want to tell you first of all, what is capital budgeting? What are we doing here? Well, capital investments are investments in large item purchases such as property, plant, equipment, or maybe you're trying to make a decision about whether or not to put a large sum of money away for a period of time, whether or not you want to purchase an investment in either stocks or bonds, and you have to decide if it's going to be beneficial to you. So there are actually four methods that are used. They're on this slide. Average or accounting rate of return is what I call it. Payback, cash payback. Then the two harder methods, net present value, internal rate of return. And they are color-coded as to how often they're used. And as you can see, the last two methods, particularly the net present value, is the most used method. There are benefits to it, and that is why it's used more often, because it considers what we call the time value of money. Time value of money means that when you invest or put your money into a savings or any kind of account, it's supposed to draw interest. And over time, that interest can build up. So that's called the time value of money, investing for the future where you earn interest. Now, the first two methods don't consider the time value of money, but they are the two simpler methods, so we want to take a look at them. So if you get your handout from Blackboard, it looks like this. Let me show you. Okay, and it's under classwork for capital budgeting. It's several sheets, and either print that out or follow along with me. Now, the first one, the average rate of return or accounting rate of return is what I've called it, uses a formula here. That formula is to take your average annual income and divide it by the average investment that you're considering. Okay, average annual income divided by your average investment. Notice how they do that. If you're looking at the investment, you're talking about what you paid for it minus your residual value, meaning what you can get from it for resale at the end, and you subtract that and divide by 2. Now your average annual income is going to be your income divided by 2. So let's take a look at the first problem that we have. Okay, this is what it looks like. Machine costing $500,000, no residual value. Okay, estimated total income $200,000 over a useful life of 4 years. So to calculate the average rate of return, we want to use this formula. So let's go back to our handout. Okay, now if you'll notice the asterisks here I've put, that shows you the two calculations we have to get before we do the division. So in getting your numerator, your average annual income, what you're going to do here, this is, okay, it's not an average by dividing by 2, but it's an average over the 4 years. So what they're talking about in this first one, I'm glad I checked on that. You want to take your total income and divide it by your useful life. So taking your $200,000, which is up here in the top of the problem, estimated total income, useful life is 4 years. So if you make that division, then that means over the 4-year period, you're talking about $50,000 a year. Okay. And then the denominator here is to take your machine cost, and this should be minus, please make a correction on that, this should be minus your residual value and divide that by 2. Okay, so $500,000 minus the residual value, divided by 2, and that's going to give you $250,000. Okay. Now take these numbers and take them back up to number 1, and you want to take your average annual income of $50,000 and you want to divide that by your $250,000, and that is going to give you 20%. It's going to come into your calculator as 0.20. Now, what this tells you is this is the percentage from an accounting standpoint that we expect to get from this investment. It doesn't tell you much unless you compare it to something, so come down here in number 2 and compare this rate to the minimum required rate of return, and that's called the internal rate of return. Okay. What that means is the internal rate or minimum required is what the company expects to get off of an investment. And in this case, they expect to get a return of 10%. Okay? They won't accept anything below that. So the key here is if the accounting rate of return is greater than the internal rate of return, okay, then you want to accept. So the accounting rate of return is 20%. That's greater than the 10% that they expect to get off any investment. So we do want to accept and purchase this machine, this piece of equipment, this machine. Okay. All right, now that one's real simple. Let's go back to the PowerPoints. Tells you just what I told you about how you make a decision here. Let's look at some advantages and disadvantages. This is easy. It looks at income earned over the entire life of the proposal or the piece of equipment, and it emphasizes your accounting income. The disadvantages, using accounting income is not always the best, okay, because it also includes credit sales. Sometimes you just want to refer to cash sales because you don't know if you're going to collect your credit sales. So accounting income can be an advantage and a disadvantage here. It does not consider the timing, okay? It does not consider whether some of these inflows might come earlier or later. Okay, so that's what they're talking about. And it doesn't consider the time value of money, the fact that you can invest money and earn a return on it. So again, the timing is reflected in that idea too. If you get money earlier, the more you get earlier, the more you can invest in and earn money. Now, the next type of method they used is called the cash payback, and this one's pretty simple. It's just how many years is it going to take you to recover your investment cost. Okay, so the problem with this one is going to be, not when I say problem, the type of problem we're going to use is found on the next sheet, and we have a new machine, $200,000. Revenue coming in from the machine is $50,000 a year. Expenses $30,000, and then depreciation. So if you were looking at that from a cash basis, you would have a zero net income there. That's the break-even point. However, remember, depreciation does not involve cash. So you have a little formula. I want you to notice what the formula says. Initial cost divided by annual net cash flow. So they want to change this to cash basis. That means that depreciation has to be accounted for and virtually added back in. So let me kind of try to explain what they're doing here. You have your cash from the machine, okay? We don't, and that's strictly cash. But some of our expenses here we're looking at are cash, $30,000. And then some of our expenses, such as depreciation, does not involve cash. Remember, your journal entry would be a debit to depreciation expense and a credit to accumulated depreciation. So because it does not involve cash, you need to actually subtract it out of your other expenses. So you have expenses of $30,000. If you subtracted that $20,000 out, then your expenses become $10,000. Okay. There's another way to do this, but the net amount is $40,000. So let's come to our sheet here. Another way to calculate that is if you had your cash revenue, $50,000. If you subtracted all of your expenses, what you would end up with here is $20,000. You could add back depreciation because it's non-cash. I'm sorry, that should be 20. Depreciation was 20. So your cash income for the year was actually $40,000. So going back to our formula that's in your handouts, the initial cost of the machine here would be your $200,000, but then your income or your cash income is $40,000. So come back to your paper. Initial cost is going to be the $200,000. You want to divide that by the $40,000 cash income flow. That means that you can get your money back in 5 years, okay? Because it'll bring in cash for 5 years. Now, you have to compare this, though, to a predetermined time that the managers have decided on. In this case, let's say that they want their money in 4 years, okay? If they want the payback in 4 years and it's going to take you 5 years, then you do not accept it, okay? So they want to get all their money back in 4 years. However, it will take 5 years. So that's too long. So no, do not accept. Okay. Now, notice that $40,000 a year is the same every year. Let's suppose, though, that what you have is an uneven flow. Okay, so see the next page. In other words, you'll get some money this year, but next year you'll get a different amount. Or see next page. So let's take a look at this. Now we still have a $400,000, in this case it's an investment. They changed the amount on you. Okay, the problem in this case is $400,000. Notice at the bottom of the page, now it's a $400,000 investment. This one was $200,000. So these are two totally different problems. So go to the next page and take a look at this. Okay, now year 1 will get $60,000 back. Year 2 will get $80,000 back. Year 3 we get $105 back, and in year 4 $155. What you do is you add these numbers together. You accumulate them. So in the first year 60, plus 80 okay, is going to give you 140, okay? Plus 105 is going to give you 245. Plus 155 is going to give you 400,000. So it's going to take 4 years for this uneven investment to get their money back. Is that okay? Well, on the other problem, we had a 4-year payback. So if this one is 4 years, then yes, we meet the requirement. So if management wants payback in 4 years, then you accept it. Okay. If they want to pay back in less than 4 years, you would have to reject it. Okay. This is just a graph showing you how it looks. Now let's go back to the PowerPoints. And what we have here are some advantages and disadvantages. It's simple. It analyzes cash flow. However, after the payback, after the 4 years, it ignores anything after that. It does not use the time value of money or the present value concepts, which really are time value of money is used in present value. So those are kind of the same. Now, next pages would be your homework. There's no requirement that you do this, but I would suggest you do, and I'll post answers on Thursday. So you need to go through and work these problems on these two types. This is the accounting rate of return and your payback, and I'll post the answers on Thursday. I will not be taking these up. Okay, well with that, next video will be on present value and internal rate of return, so look for that one. Take care.